So I'm George King. We're back with our In Conversation With series with mainstay CIO Damian. Welcome back again.
Great to be back.
I mean, we're already well into 2024, but we really haven't had a chance to talk about how last year finished off. So maybe before we start talking about what's happening now and what we're thinking about going forward, maybe we need to look backwards slightly and sort of finish off 2023 and share a little perspective with anyone who's watching, sort of how the year ended and if there was any meaning to that in terms of markets or movements or key events that may shape what we think about 2024.
People in the markets were a bit nervous. Markets were down a lot in 22, and everyone was scared of inflation. And this was going to be something that was structural. It was going to last forever. And the Fed were going to raise rates until they probably inevitably cause a recession. Because that's what usually happens when you have inflation. Interest rates go up, recession follows.
They overshoot and they can't control it.
It wasn't an unreasonable expectation at this time last year to think there was a recession. If anything, the opposite. We had strong growth rather than the U.S. economy in particular slowing down or going into recession. And that was something that the market took its time to digest during the year. And it wasn't until the end of the year that we saw some capitulation on that.
Right.
And a lot of that was inspired by the Fed. The Federal Reserve were talking about the outlook for inflation and talking about the possibility of interest rate cuts.
Yes.
So the market started to feel like it was mission accomplished in terms of beating inflation. Still wasn't any sign of a recession or a slowdown. And we come into 2024 and the U.S. economy is still in rude health. There's varying degrees of growth outside the U.S., but by and large, economies are doing okay.
Before we leave last year, I think it was a relief, no question, after a difficult 2022 to have what ended up being a relatively robust 2023. And you're sort of describing some events that ended up differing from expectation on the plus side. Were there revelations throughout the year that were also negative? Just let's have a balanced conversation. So we had some positive outcome in terms of what actually happened with the Fed and inflation and so forth, and ultimately market performance. But is there a balance to that in terms of, okay, we also had some unexpected negatives or seeds for some future negative that you would note, if any?
Yeah, I think there are concerns about global growth. So I think a lot of people were concerned about China.
Yeah.
And I think the concern there was whether the Chinese economy was going to rebound. And that has an impact on global markets, on global economies. And really that sort of surprise to the downside is that we didn't see more stimulus being put in place in China to help the economy grow a bit faster. So they're having the opposite problem in China. They have deflation, which is quite extraordinary. So whereas we're all talking about inflation, it's very different. And I guess the geopolitics of all that started to sort of play out a bit last year as well.
And that's clearly continuing this year. And maybe we'll touch on bits of that, though. That's not our area of expertise, obviously, but it's noise in the markets. When I'm having conversations with clients, I think that's true of a lot of advisors at MASECO, as we're having continuing conversations with clients about portfolios or just catching up. It's hard to resist using these last 2 years as a real case in point, sort of about market timing, about investing through cycles, about not being reactionary, about not thinking what's going to happen next. Would have been very easy to come off of 2022 very scared, very risk averse, try and shift away from risky assets and then miss what happened in 2023. Would have been very easy to start 2023 and say, everyone knows it's going to be this and that and so forth, and try and position as such. And so it feels like a very real-time lesson in looking through cycles, investing in a diverse way, not trying to time I suspect you're having the same conversation.
Absolutely. And it's interesting. I mean, we're having these conversations with peers as well, right, in the industry. And you remember at the beginning of last year how many of them were quite nervous, and they were turning down portfolio risk because, you know, they don't have the same philosophy as us, which is more long term. We're not trying to do tactical moves in our portfolios. So a lot of our peers, didn't they kind of just turn down the risk in the portfolios?
Yeah. And I think you find it especially with the asset managers, with the fund managers who feel like they really have to try and track markets and move things around and show their value by doing something. Hopefully, as an advisor, as a wealth manager that's using various funds to build portfolios, you're doing that in a way that has risk and has offsets to risk, and therefore is building in some of that resiliency to market moves up and down.
You know, we were talking about earlier last year when there was thoughts of recession were prominent in the foremost people's mind. You can understand why people took risk off. And as you said, you know, it was very easy to try and time the market by reducing portfolio risk. And it's proved to be very difficult. I mean, I think you could go back even further in the last couple of years. You could go back to COVID times and, you know, or the time of the Ukraine invasion. It's amazing the market's ability to get over these things, right? And I think we never really fully comprehend the resilience in company profitability. You know, we always think that there's going to be some event that's going to topple things over, but it just doesn't happen that way. You know, it's company profitability is still resilient. We still will go out shopping, and we'll still go out and have entertainment and stuff like that. That's life carries on.
It's a good perspective because so much of market commentary, so much of headline is focused on the margin. It's the marginal change. It's the fact that this went up slightly or down slightly. It doesn't matter that the mass is still the same, right? It's still that hundreds of millions of people are still living in their homes and buying things and doing something. And on the margin, there might be a few more that sadly lost their job or a few more that got a job, but that's on the margin. The base economic drivers, the base creation and activity is still going on, and that's what's reflecting in that sort of resiliency you're talking about.
That's absolutely right. Yeah, and we're seeing it continue this year. I mean, people are starting to talk about recession again or a slowdown coming because we're always conditioned to worry about the worst, I guess. And actually, company profitability so far is pretty robust this year. So we can't predict it's going to continue. But I think, you know, we have to be humble about trying to know when that will happen. I mean, Alan Greenspan, the Federal Reserve Chairman, said legendary chairman, of the Federal Reserve. Do you remember back in the late 90s, I think it was around 97, 98, he was saying, he had the expression irrational exuberance.
I loved that expression.
Yeah, wasn't it? And it's something that spooked the market for maybe a day. I mean, in some ways he was right because we had the tech bubble, which actually didn't burst until 2001. And interestingly, when it did burst, it went back to a level that was still higher than when he said the market is irrational. So, you know, we have to be humble about these things and not say, you know, the market it's gone up a lot, but that doesn't mean it has to come down.
Yeah. And one of the great lessons, I think, from a lot of hedge funds that blew up in the 90s and noughties is markets have the ability to be irrational for longer than you think and maybe longer than your capital can endure. So just because you think and maybe are right that they are beyond the bounds of what maybe makes sense in the long term, to try and time that, to try and think you can move money and reflect that, it's a dangerous thing and difficult to do well.
It's and it's understandable, I think, because we're all behavioral, aren't we, when it comes to investing? And if there's a discount on in a shop, we're all happy to go and get a deal. But if there's a discount going in a particular market, we're like going, whoa, something's wrong there.
But that's actually a useful shifting point to start to think about going forward. We were talking about, you were giving some perspective around the generic expectation and fears at the start of last year. We have a little bit of that now. It's a different topic. It's not about inflation and Fed and so forth. Now it's about election cycles. It's about, two hot wars and other geopolitical conflicts. It's about other topics that are the new reasons to be nervous. And I guess if you're in investing, there's always reasons to be nervous. So let's not pretend that we have a crystal ball, but are you particularly nervous going into the year?
Absolutely not. No. I mean, you're right. This year, I think there's over 65 elections. Okay, so there's almost one every week.
Like more than half the world's population, some crazy number.
Extraordinary. This confluence of these elections all in one year is pretty phenomenal. So, what are the implications there? There are implications, obviously, for different countries of political change, but you can't anticipate. You can't know what that's going to be. Our job isn't about trying to figure all that out, thankfully, right? Our job is just looking at people's portfolios and their wealth. And is there something looming that you can see coming where you would want to change direction, where you would want to change risk? And we just don't see that. We've been through so many elections. They're so hard to predict. Even when you can predict them, the outcome can be very surprising, as we've seen in recent years, right? We've had things like the Trump election, which was a nervous market reaction initially, and then there was a rally, and Brexit, a similar situation. So you have to be very careful about things like this. And that's why we're not going to be making any changes for reasons like that. We're not going to be tactically tilting away our portfolio or changing the risk levels. But I think you're right. I think a lot of people, it's a very sort of, it's a very strong concern. It's a very visceral one for people. No matter what your politics are, people are going to be animated by what's happening and the discourse that's going to be happening over the year. I'm sure we're going to be talking to clients. This won't be the last conversation we have on elections, right? And I think it's important to have the conversation with people.
And I'm just going to take this a little bit deeper, because a lot of people know that they don't know. They know that they're sitting at home. They're not experts in markets or geopolitics. They're reading the paper. They have a general nervousness. And so hopefully more of those people are open to hearing this perspective and saying, okay, I get it, and maybe, relaxing a bit. But there are also people that are experts. There are, geopolitical experts. I talked to someone the other day that had been at Davos all the time, is, in the midst of, the expert community around geopolitics. And her perspective was, the world has not been in a more precarious position since World War II because of this, that, and so forth, and geopolitics and isolationism and all this stuff that she's an expert in. Fine. And because she has this specialized knowledge, she says, no, I really know it's different this time. I really know that and having the conversation about what may or may not happen in the world, and then linking that to what you were just saying in terms of, even if you knew, you don't really know what that then means for markets, for specific investments, et cetera. I think that's such an important message.
Right. And we've been through many elections. I mean, I remember back in the Bush, Al Gore, I was staying in the U.S. I was on a research trip to the U.S. I was staying in the Essex Hotel, I remember, in New York. And I woke up in the morning after the election results, got my newspaper, and it said, President Al Gore.
Save that.
I wish I had saved it, And of course, that it didn't turn out that way for him. So you can't predict these things. You can't predict the consequences or what's going to happen. What's going to happen at the presidential level or Congress or Senate? There's all kinds of machinations, And I think we've always talked to clients about trying to control the controllable, and that's just something you can't control.
I think funny enough, I think there is a slight divergence in our worlds on this. So those of us at MASECO sitting in the sort of the wealth advisory roles, and there's obviously a lot of us, I think we do have to think a little bit differently about some element of election. So, if a particular party is promising to make a particular change to wealth rules or taxation rules if they get in power, we can't totally ignore that. We don't know if they'll get in power or if they'll actually be able to do that, but we do have to have some conversations with clients, sort of just scenario modeling to say, well, if this happens to this taxation regime, this is what it means and so forth. We don't make the shift assuming it's going to happen, but we do think about it, and if it's that explicit. But I don't think there's anything that's that explicit in your world where someone gets elected and you know it's going to have some impact on how you invest.
Are you sort of seeing scenarios where there might be some significant change?
You have parties talking about abolishing inheritance tax or about, changing pension rules or various things in different election cycles that, or lifetime allowance caps and various things. So you can't ignore those. If they've said explicitly, this is what we're going to do, you can't just say, we're going to pretend we didn't hear that. You do need to have a conversation and say, look, here's the current rules. This is what they're talking about. This is what the delta would look like. Again, you can't assume it's going to happen, but you do need to at least proactively have that conversation. But I can't think of anything like that in the investing world where it's so explicit that, you can start modeling if A wins or B wins, this is what it may mean to markets or investing. And there's nothing that direct.
I mean, if we were to do a study of what politicians say before elections and after elections, I think we'd see some different sort of outcomes to what they were promising, right?
But so.